Okay, hello everyone, and welcome to BFW 2401, week 8, credit risk 2. So in this week, actually, we will cover the rest of the credit risk models, the new models which we have, and credit risk 1, and then we will go to the portfolio risk. So if you allow me to share my screen, then let's start. Okay, so this is what we are talking about. We are talking about the week 7, week 8 actually, which is actually a combination between week 10 and 11, because we are using some of the models from week 7, from week 10, and then week 11, actually, we are talking about the portfolio risk. Now, coming back to this screen, as you can see, we are actually working in this area. Mainly in this area, just to allow me to hide this one. So we are actually now working working mainly in week 8 portfolio risk, but we have some things coming from week 7, which is actually some of the credit risks models. Now, this is the whole thing. If you look at the of our map for the unit, we are about to finish the semester. We have only 4 weeks more to cover some of the other issues. So this is actually, as I told you, we cover part of chapter 10 and mostly chapter 11. Okay. Now, this is actually what we want to talk about, the RORAC, the models, the new models. So we are talking about new models, new models for credit risk measurement. Um, to just put you in the picture, maybe this is one of the most technical part for those 3 models. This is actually one of the most technical part in week 7 and 8, and if not in the whole unit, especially when we talk about the option models for default risk. The reason I'm saying this because it involves a lot of stat and a lot of option pricing and all of those issues, but we will go over them. We need to shift a little bit our thinking when we talk about those models because it involves too much use of the normal distribution and extracting the premium and the risk. Okay, so this is actually, as I told you, this is my first part for week 8. This is the part 1. And then we will go to the normal part, which is part 2. Now, we will start with the RORAC, and RORAC stands for a risk-adjusted return of capital. It was pioneered and actually developed by Bankers Trust. So it's an idea. The concept is you are not taking the ROA of the loan when we calculate it for the RORAC. We are not talking about the income, the whole income, which is the interest plus the fees over the what we call the loan value of the loan. This is the normal ROA. When we talk about the RORAC, which is the risk adjusted, we are saying, okay, we can invest in the risk-free because we are talking about only, if this is K, which is the normal corporate rate, and this is the risk-free, and this is actually the premium. Now this premium plus the fees the premium plus the fees is actually what we use for RORAC. We don't use the whole K, but we use only the marginal, which is actually the premium plus the fees. Now, what about the numerator? Numerator, we use, this is the denominator. This is the numerator. The denominator is actually the risk of the loan. Now, the risk of the loan, remember, we are not using the loan, and we are not using this, we are using this. And the risk of the loan is the change in the value of the loan. And this is, we'll find, this is step one. Now, in step two, we will check whether the RORAC, which is this marginal return, actually more than the required rate of return for the shareholders, which is the ROE. If it is correct, then we accept. If the RORAC actually less than the ROE, which means we are not giving the shareholders the expected return, then we reject the loan. So actually, to say it differently, I have an option to put my money and get a risk-free. This is one option. But of course, I will give it, this is the risk-free, which is government securities. Or I have another option, which is invest with corporation, and they will give me K. Now, this K is actually will be higher than the risk-free by the return, which means the K equals the risk-free plus the premium. Now, this premium with the fees, which is the additional values, because if I'm getting this one, I already know that I will get at the I. Now I'm saying, no, I'm going to invest it. And I will see, I want to see whether this investment is actually visible to me or no. And it will be visible for me if the premium plus the fees actually equals the ROE. This is the normal thing. But in RORAC, we want it to be more than the ROE because we want this, because if the RORAC is actually higher than our ROE, we are actually giving the expected return for the shareholders, and we have a surplus, and that surplus will lead us to growth. So we are paying the expected return of the shareholders, and in the same time, we are growing. This is the whole concept. So actually, as I told you, we are discussing the incremental return, which is this part, over the incremental risk, which is the change in the loan. Okay, let me see now how we can do it. If we understand the concepts, let's see how can we do it. The problem is, if the RORAC as I told you, is actually the fees plus the premium, and this is the change in the loan, this is straightforward. We can get it. This is straightforward, easy to calculate. The problem is here, the problem is estimating the risk or the change in loan, or the change in the loan. So this is what we are going to do. So the maximum change in credit risk premium can be estimated using publicly available data, which means we have to take the change in R, which is the maximum change in the all companies, we will take all the companies because we are going to build now a normal distribution, all the companies in the same category. So if the lender from B class or double B or from A, triple A to A, that is one category, we will make them in the RI. So all those companies will have company one, company two, company three. So we will have something like this is the category, and we have company one, and its RI is a number. Company two, company three, all of those, for example, the AAA. And then we have the risk free, which is, so I will decrease it from the risk free, say it's 5%, for example, and we'll have here a plus or minus, right? Or zero for each one. All of those observations, all of this actually, which is the change in R, I will build a normal distribution. All of those values. Now I am in a situation to build a normal distribution. And from that normal distribution, I can statistically estimate the change in R. So all of this and 99%. So the normal distribution will be like this. And this is the plus, this is the minus, and this is the RI, which is the K for each companies in the area, minus the RG, which is the risk-free. So I will take all of those values, which is this, the change in R, for company 1, 2, and 3, all the ones in this category, plot them here, and then I will have a mean. Remember, when we have the minus, which means the RG is already higher than RI, which means this is a minus premium. And this is a plus premium, which is the normal thing. It can be a zero, this is zero, okay? Then I will distribute it and I will get this value, which means when I say a higher premium, which means actually the risk of this is the risk, because when the premium is increasing, the credit risk increasing, right? Because I am taking RI minus RG, which is the risk free. This is the risk free. And this is RI1, as I told you, RI2, and I continue like this. So the premium is actually reflecting the risk. And it's reflecting the risk of all those companies in the same category. So if there is a company from issuing bonds, or I gave them loan and they belong to this category, probably they will have this premium and the change in loan. So I'm actually in this area plotting all these premiums, whether they are minus or plus, which means whether they are more than the RG or less than the RG, as I see. See, this is the less than RG. This is the higher than the RG. I want you to understand it from this perspective. And let's now see, so what do we have in the duration? So the change in loan, this is the formula we'll use. As I told you, the RORAC is very easy to take the premium, the fees plus the premium. Now, what about the change in the loan? The change in the loan is actually this formula, which is minus duration times the change in loan, change in R, times the loan change in R. This is the change in loan. This is change in loan over the loan equal duration change in R over 1 plus R. If you want just to take the change in loan, and then you will have the duration times the loan times the change in R over 1 plus R. This is the whole thing. This is which I take from the, this is the whole thing, or this is the important thing which I take it from the distribution from here, which is this area. The rest, I can just get it easy. Look at this example. So if we have a loan of 1 million, and we have the duration of the loan, which will be given 2.7, and we have the return of 10, and we have the return of specific issue, is RI is the return of specific issue, which is all companies, and this is the RG, which is the risk-free. Now I am at, all I need now is to calculate this one according from the normal distribution. As you can see, this is the plus, this is the minus, this is the change in premium, this is the change in premium minus, and I am interested in this area, which is the maximum risk. When I take the maximum premium for those companies is 3.5, which is the maximum risk. So if this company is issuing me, I'm buying their bonds or giving them a loan, I'm expecting the changes and their risk to be like this, up 1.1. If they, this is for the whole, this is actually for the whole, as I told you, issue. So it can be any ranking, okay? So now, as I told you, I have the, I can calculate now easy. So the RORAC, as you can see now, is the fees plus premium. And the change in loan, I can calculate it, which is the, which is this formula. Which is minus the duration of the loan, 2.7. The loan is 1 million. And then we have the change in R, which is 1.1 from, which is this one, over 1.10. 10 is R, and this is the change in R. And then I can calculate it. I just need to know how much the fees and the premium. I think in this example, yeah. So I get now this to be 27. And suppose the spread is 0.2% and the fees is 1%, just 3% times 1 million, which makes it not 3%, actually 3 basis point, which is 3,000. So I can now calculate this. So this is 2 basis point, 20 basis point, and this is 2 basis point, and this is 1 basis point. So we get it to be 3,000. So we'll find this to be 11.11. So remember, I told you when we talk about the RORAC, we have 3 steps. First of all, calculate the RORAC. First step, calculate RORAC, and we already calculated to be 11.11%. Number 2, compare it to the ROE. Number 3, accept or reject. Now, as you can see, what will be your decision if the ROE, I have the RORAC now, which is 11%. So now RORAC is actually is higher than the 10%. So in this case, I will accept the ROE 10%. Of course, now RORAC, which is now this is 11.11%. The RORAC, which is now, this is the RORAC. RORAC is now actually less than the 12%. And of course, I will reject. What is actually, if the RORAC equals the ROE, which is 11.11%, you can consider. And usually we take it. So the question now, what is the implication on the share price and the shareholders' wealth given in the above outcomes? So if we are talking about here, this will decrease the share price because I am investing in loans. This will increase, excuse me, this will increase the shareholders' wealth because I am investing in loans, which is giving me a spread more than satisfying the ROE, which is my cost of funds, actually. I'm investing in 11.11%. The required rate of return is 10% for the capital. So actually, I will, if there is a dividends distribution, I will distribute the 10%. And 1.11, that will be stay in the company. And the shareholders will be happy with that. And then I can increase and the company will grow, the bank will grow. So it will increase the shareholders' wealth and it will grow, which means I'm already satisfying the cost of capital. And also I have an extra, that extra will lead me to increase the shareholders' wealth and grow. What about 2? 2, no, will decrease. It will decrease. So, and this is why we reject it. Because cost of capital is 12%. I'm getting less than that. And this one, you can just accept, it just satisfies the ROE. This is the implication of this. So one increase, this is no different actually. Okay. This is the whole story of the RORAC. The only technical thing is when we use the normal distribution to calculate the change in R. And the second, a technical thing is we are not calculating, as I told you, the ROA, this one, over, we are not taking the ROA, which is, we are not taking the ROE, which is the whole interest over the loan. Now we are talking only the marginal premium, which is the premium and the fees over the premium risk, or over the extra risk, which is actually the change in the loan, change of the value of the loan, which is the change of the value of the assets of this company. Now we will move to the next one. So as I told you, this RORAC, just to give you here, RORAC can look forward and backward, which means I can calculate, just to come here, can calculate expected return over the change in the loan, which is, this is forward. Or I can calculate historical return or historical return over the change in the loan. And this is, as you can see, backward. This is when we say it can look backward and forward. Um, some other thing also, RORAC, and unlike other ones, RORAC do two things for us. RORAC actually give us a benchmark, which means if somebody, the RORAC, which is counting this, if we get this one over the 11.11, over the ROE, we accept. This is a benchmarking. But also it gives us pricing, which means I can now issue the loan with 11.11%. By issuing the loan by 11%, I am achieving two goals. One goal is it's already, this loan is actually passing my benchmark, which is the RORAC over the ROE. And the other thing is I am pricing the loan with the same thing. Look, the other, for example, the Z-score for Eltman, the probability, linear probability model, and all those models, they just tell us the benchmark, whether we accept or reject. Now, the pricing is different issue. How much we price is a different issue. It just that one is tell us whether we accept or not accept. Then the pricing, we will use the K. For RORAC, it's already ready. And this is actually what this statement is telling us. As I told you, by the RORAC, we add to the value here what they're saying, spread and feed, which means we add to the equity value. And also please understand that RORAC is actually surfing for these two purposes, the benchmarking and the pricing. Okay. Let me now talk about the probability of default on multi-period. This is the behavior of the long term and short term. Now, what is the probability of default? As I told you, if I is 10% and I'm giving K for 15.8, I can say that 1 plus I, which we talked about, equals the probability of payment 1 plus K. And if this is the case, I can calculate the probability of payment for year one, which is 1 plus I over 1 plus K. In this case, it will be 1.10 over 1.15, which is, I think, 95%. If I'm not mistaken, I think this is what we have last time, one. Yeah, it's 95%. Now, this is okay. Okay, what if I want, the problem is, what if I want, if this is for 1 year? Because based on this, I will see the probability of defaulting. Now, I know the probability of defaulting is 1 minus B, which is the 5%. But if I want to know the probability, if I'm concerned about the probability of defaulting in year two, this is usually the loans is not for 1 year, for more than 1 year. Then the problem is I need an I and K for year one, if to calculate for year one. If I want to calculate for year two, I need I2 and K2. If I'm going to calculate for the default for year three, I need I3 and K3. Why? Because probability of payment for year two is actually 1 plus I2, 1 over K2. And probability of payment for year three, the same thing. It's 1 I3 over 1 plus K3. The problem is I cannot calculate this easy. So this is what we are going to do in the multi-period. So think about it of 1 year or 2 years, but the concept is here. I am interested to calculate actually I2 and K2, if I'm talking about 2 years, or I3 and K3. Because I1 and K1 already know. I already know which is the spot price. This is a spot, and this is forward. It can be year or year. So let's just give you an example. If I want to calculate the probability of payments, regardless of this is just an example. So I can still calculate this and this, but I gave it to you ready. So when I gave it to you ready, I told you the probability of defaulting for year one is 95%, assuming the probability of payment is 95%. And the probability of defaulting for year two, 7%, assuming the B is 93%. Fine. Now, in this case, I can calculate the cumulative probability of payment, the cumulative probability of defaulting, which is actually 1 minus B1 times B2, which is actually the 95% times the 93%, which is this one. And this will be like 11.65%, which means that defaulting over the 2 years will have 11.65. Now, the defaulting in the next year, as you can see, is even higher. So you don't know the third year, the fourth year. So when you price a loan for long years, you want to see the defaulting are not going to be the same. The defaulting will be changing over years. So to do that, we need to calculate actually B2, B3, B4, depends on the loan. And this is actually a challenging issue. So the concept here, this is another example, as I told you, the probability of payment, if this is 96, if the probability of payment for year 96%, and the probability of payment for year two, this is just another example, 94%. It's very easy for me to calculate the probability of defaulting over the 2 years, which is 976. I'm just using the same example. But coming back now, the problem is, as I told you, to calculate the B2. The B1, I already know it. So the question is, if you have all spot quotations for short-term and long-term, how to calculate the probability of payment for year two. So the way to do it is the way we do it to calculate the concept is like this. So when you go to the prices, when you go to the market, you have spot prices. Which is the short term. And you have forward prices, which is actually the long term. So if they tell you spot prices, I can give you now investment for 1 year, how much from now? And I can give you investment for 2 years. And when I say 2 years, meaning and it is 6%, for example, meaning I will give you 6% in this year and this 6% in the second year. And we decided on it now on the spot. So for example, this is 7%, and it will be like this, 7%. And I don't know how much is the next year if I'm going to invest for 2 years. But for a spot, as I told you, this is 6% first year, 6% for the second year, and that's it. Now, in the long term, and therefore, if I want to calculate the long term, which is this one, I have to use those two issues to calculate this one, which means if there is no arbitrage, no arbitraging means the information is available, all the information available, so I know what is the rate here for I2 and K2. I know what is it. I mean, the arbitraging will tell me there is nothing hidden and all the information is there and it's available for everyone and everyone can forecast what is this. If I can know that, so for the investor, and there is no arbitraging, for the investor, it doesn't make difference with him whether he invests for 2 years or invest for 1 year, liquidate here and invest for the second year. He will get the same return. To translate this to calculation, I can tell you 1 plus I2, for example, which is the this one, one plus I2. It should be this one, 1 plus I1 plus 1 plus the forward rate for year 1, which is this. This is the forward rate for year 1. And this one should equal this if there is no arbitrage. The same thing, I can do it for crop rates. Now, this is for spot rates, for example, for the risk-free. Crop rates can have the same thing, which means I can have now K1 and K2, and then, so I'm investing for 2 years, then I can have here maybe 9% from now. And for the K, I can have this one, which is maybe 8%, don't know. And this one could be not known. So I can calculate this. This is actually the forward for the crop rate one. So actually for the crop rate, then in this case, with the concept no arbitraging, I will have the same thing, which means this 2 years, and this is for 1 year. So I will have 1 plus K2, it will 1 plus K1 times 1 plus forward crop rates. And there is assuming, as I told you, no arbitrage. No arbitrage, which means the information for the short term and the long term is there. If I know that, then I can calculate, I can actually get the fit one, which is actually 1 plus I2 to the power of 2, 1 plus I1. And then I can calculate the F1, which means I can take this one, take one, make it like, and calculate F1. Same thing, I can calculate S1, which is actually this one plus C1, which is the crop rate, the forward crop rate, which is 1 plus K2 over 1 plus K1, or I can say this one minus 1, and then I get, remember, I get now F1 and C1, which is for year 2. So in this case, I can calculate B2, which is the second year, which is I just take 1 plus the forward of year 1 and the forward of the crop rates of year 1, crop rate forward 1, and which means the second year for both of them. So if I get B2 and I already have B1 is known, I can now calculate the probability of defaulting of year 2, which is 1 minus B1 times B2. And they continue like this. I can calculate for the third year. So I want you to know it from this perspective. And to go now to the example, there is nothing, so as I told you, this is what we are going to do when we calculate the B2. It's this one, just what I explained now, which is the forward for the risk-free and the forward for the crop rates, and I can get B2. And I can get it from here, as I told you here. So you can take this one and make it like this one, and then you can get the crop rates, or you can get it for the forward. If I give you an example, and I told you now the current required deal on 1 year or 2-year treasury, for 1 year is 5.05. For 2 years, this is the long term, which means I will give you 6% here and 6% here. And here, I will give you 5% for the first year, 505, and I don't know for the second year. So to calculate now, according to this, I can calculate the K2. As you can see now here, if I want to calculate the forward for the risk-free, I'll just the I2, which is 1.062 over 105. So I get 19, I can calculate this, which is 696. So this is actually the forward for year 2. So this is actually 696%. And this is 5.05. Now, I need also C2. So to calculate C1, I have also, they told me it's, if it is K1 10%, if it is for 1 year, this is for the forward for 2 years. This is for the 2-year long term, which means this is for short term. So the short term looks like this, 10.8%, and I don't know the second year. But this one is from now, it's a spot. They told me I will give you here 13%, and I will give you here 13%. I want to know actually how much is this. So when I calculate the C2 at the same formula as I told you, I get 1 or 15.24%. Now, actually, I am now in a position to calculate the probability of payment for year 2, which is actually this divided by this. And this is, it it comes to 92.81. This is 1 plus K, and this is 1 plus I. And if you want to know how much C2 is actually 15.24%. Then I calculate the P2. Now I'm in position to calculate the probability of payments, a probability of defaulting for year two, which is 791. Just this is for year two. If I want you to calculate the probability of defaulting over the 2 years, then you have to say 1 plus P1 times P2, which is the P1. I can calculate the P1, which is 5.05 plus over 10.8. No problem. But anyways, this is P2 actually, which you already get it. P2 is 92. This is how it works. So I want you to know it from this perspective when we talk about multi-period. Now, this is maybe the most technical one, which we are talking about the option pricing, option model for default risk. Now, this is coming from what we call the theory of this option pricing. It's coming from what we call MPS. Now, MPS stands for those people who developed the option theory, which is the Merton, Black. Those is the 3 authors, just for and what we call Scholz. So to give them observation, we call them MBS. Anyways, MBS, they identify the option theory, and the option is saying, briefly, saying that the firm can take a loan from a bank or issue bonds, take a loan, or issue bonds and because the firm is limited liability, which means we don't go to the assets of the individuals, but to the firm itself. So they have this limited liability, which means if there is any losses, the bank or the borrowers can take over the equities of that specific company. They don't extend to the assets of the individuals who are forming this company. And this is why we are saying it's limited liability. Based on that, now I can take a loan, and actually the collateral or the security for that loan is the equity of the company, whether it's a loan or whether whether this company issue bonds, either the issuing bonds or it's a loan. The guarantee for that one is actually the now KMV, which was acquired by Moody's, which is one of the rating agencies, has developed a model for credit risk based on this concept. So the concept is saying, I want you to look at this. B is the loan. A is the value of the company, the equities, the market value of the company, which is the assets. Now, when you are operating, it can be, this is the debt. So if the value increased, and this is the payoff for the shareholders. As I told you, this is like option. This is the payoff for the shareholders. So the shareholders is like holding a call option. And this is like the fees of the call option, which is the equity. Call option. It's like a call option, which means they have the right to buy. So if the assets of the company is becoming A2, of course, the equities, the shareholders will not. So as you can see, if this is, for example, 100,000 or 100 million loan or bonds, if the value of the company becoming 80, it's already defaulting and the shareholders will leave it. Okay. And if the equity of the company is becoming more, say here 200 million and here 300 million, just will continue. This one will continue. 400 million will continue. Shareholders will not sell, and this is will be their payoff. You know, so they will continue. So this is actually representing the payoff. So when the shareholders will give up, when they will exercise that call option and say and give up the company, it's here. When the value of the company is going under the value of the debt, which is this is B, the debt, and this is the value of the company. So actually here B is higher than A1, and this is here A2 is B. This area is B is less than B2. This is how the call option works, the concept. Now, if you look at the payoff of the debt holder, which is the bank, if the value of the company goes down, so this is his 100 million, and the value of the company keep going. See, the value of the company here is 100 million. They will give it up, 100 million. Even what I mean, that is their investments. They will give it up. Here, if the value of the company drop under the value, which is this is the A1, right? Assuming this is 80. Here, already 80. If they take the, which is now 80 is less than 100, so the bank or the debt holders, if it's stocks, if it is bonds, they will take over. They will take the equity. And they will continue here until the value of the equity becomes zero. So this is their payoff. If the value of the company goes down, they will take the equity and what is left from that equity until it becomes zero. But if the company goes up and it becomes, and B now is becoming much less than 100, which means it can be here, it can be, as I told you, 200 million. The value of the company is coming 200 million, 300 million, as I told you here. Even in this case, the shareholders will only take, the debt holder will only take this value, which is the bond or the loan plus the interest. Whatever the increase in the value of the company, their payoff only, their maximum thing they can take, loan plus the interest. And this is why this is regardless of the value of the company, they will have only this. So this is the payoff of the debt holder, which is different from the this payoff. Now, based on this concept, when KFB come and develop this model, they want to see, when you have a company like this, how much you charge as premium, the pricing. And this is why they default this model, which I will talk about it. Of course, now, if you look at the distribution, this is a different distribution, okay? Remember, this is the minus. This is what we call EDF, which is expected default the expected default, the EDF, which is the probability of defaulting here. This is the plus and minus. It's different from the normal distribution. This is a distribution called EDF. Now, this is the whole distribution, which means the value of the company, the value of the company, the value of the loan is actually the value of the company because you can take the company. So unless here, this is the defaulting. So you want to calculate the probability of defaulting here so you can get the premium. Remember, if you are here, you are actually talking about, if you are talking about B of 100 million, a loan 1 million, until here, when it goes, the value of the company goes to 80, the value of the company can go up, as I told you, 400 million, 500 million. But when it goes down below the 100, this is the defaulting. Now, this defaulting, you have to this defaulting, you have to calculate as a probability, and you get the premium. This is one thing. The other thing also, you can value the value of the loan in any time here. You can value the value of the loan in this area. How much is it? Okay. So it includes some probabilities, and I want you to be with me when I'm discussing this. If we, if we are, we succeed in explaining this, it will be a good thing to do. So this is actually the premium, and this is the value of the loan. Now, when we do that, the problem is when we calculated this ADF, we have to go through this formula, which means we have to go to calculate something called H1 and H2. And H1 and H2 is actually the area actually this is the value of H2. H2 is here. And H1 is actually here. So you want to calculate the value, the Z value of H2 and H1, and then you have to see calculated the probabilities, which is from the tables or from Excel, that will be given to you to calculate this area, which is the area after H1. Okay. This is what we are talking about. Let me just tell you here. Give you an example. Look at this example. Assuming you have a loan of 100,000, and this loan is for 1 year, and the I is 5%, and the what we call the leverage is 90%, and the standard deviation is 12%. And you want to calculate now the value of the loan, and you want to calculate also and you want to calculate according to these formulas, which is here. You want to calculate the value of the loan, and you want to calculate the value of the loan, and you want to calculate what you call the premium. Now the premium here is, according to these formulas, you have to calculate H1 and you calculate H2. Now this is the values under the curve, but you want actually to calculate, this is, as I told you, this is the EDF, and this is the minus, this is the plus, This is a different distribution from the normal distribution. The minus is coming to the left, and this is coming to the right. And this is, as I told you, H1, and this is H2. So actually, the H1 is coming here, actually from here. So you want to calculate the area after the H2. And then you want to calculate the area after the H1. This is what we are doing here. So the H1 we find it to 938, and the H2 find it to be 18.8. Now, when we calculate the value, when we calculate the value of the, according to this formula, this is the formula of you calculating the value of the loan. And when we calculate it, it becomes 93,000. Now remember, the loan is actually 100,000. These people already defaulting, okay? And then the value of then the premium, which is you want to calculate the probability of one after this area, which comes to 1.33%. So this is just the premium for this type of company, for this defaulting. Now, how much you will charge this company? If the value is 6%, if the risk-free is 5%, now the premium for this company is 1.33, and which you will actually charge them when you price 6.33% for this loan, or for this, or there is a collateral, of course, as I told you, is the equities. For this loan and for this, um, or for these bonds, you will take a coupon of 6.33, or you will take an interest of 6.33. But the premium, which is the most important thing, is 1.33. This is the whole thing, and I don't want you to confuse yourself. You have too many calculations and the tutorial. You can also read about this. So if you have, for example, a loan of 80 million, if the loan is 100 million and the loan is becoming now 80 million, and the standard deviation, and we have standard deviation, which is 12.12, you can calculate now the what does 80 million means. 80 million means it's actually the decrease of 12.2 this is the standard deviation. This is 1.65 times 12.2, which is the 20 million. Now, after below the 20 million, this is a 5% in a 5%. So after the 20, after that, the 80, that 80 million is actually coming, the drop of 20 million. If you have a loan here, look, if you have a loan of 100, if you have a company value, this is the equity. And the loan is, as I told you, 180, which means you are talking about 80% leverage. Now, because the value of the loan is the value of the company, when this company will default, when the equity becomes 80 or less than 80, actually 80 and less. This is when the value of the company um, becomes defaulting. Now, because you are taking the equity, because you are taking the equity and the price of the equity in the market, which means now this equity is actually, if you take the standard deviation, which is 12.2, 12.12, that is 12 million. So if we have that one, we will actually default when we go um, under the 80 million, which means if we have a standard deviation of 12.12, then in this case, we expect the price to go to 80, and this is where the defaulting starts. So um, this company will default if it has that standard deviation, if they have that, if it has that variance of 12.2, and the value of the company goes from 100 to 80. And this is, as I told you, the distribution. And this is just one, if you need to, um, this is one observation. When they use this model, for example, we have this company. So this company, they calculate, they calculate, this is one of the companies that, that was defaulting, which is AMR Corporation. This company filed bankruptcy in 29 of November 2011. Look, if you look at the, this is the three rating agencies with their models. So this rating agency, Moody's, was following this company through their modelings, and they are rating them as B minus here, and then it goes to deteriorating to triple C, and it continues like this until it collapsed. So through all these years, from June 2008 to 1 February 2009 to 2011, when it was defaulting, this is the rating. Now the rating of S&P was actually taking them as between B and B minus here, and it continued like this. It only, the rating was dropped is only here from B to C when in, starting in this year in 2009. Now, but if you look at this model, which we are using, the option pricing model, they start to, they started with the C, not with the B, and it goes up and down, and actually it was already here close to defaulting. So it drops to C, 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 and goes down, down, down. So it was very accurate. So when the company was defaulting using the EDF, when the company was defaulting, these people still consider it as triple C, which is not defaulting. Both of them, Moody's and the SAP. But when they use the EDF, which is the KMV model, it was dropped to, it was actually collapsed here. So this is the whole thing which I want you to be aware that this model is very accurate and used now by too many banks. This is actually the end of part one. Thank you. I have taken a long time in this part. Hopefully you will understand it. But um, we'll see you in the second part. So please discuss it. Please look at it, and we will also, discuss this in the tutorial. But the option pricing is a little bit, it has some statistics, whatever. I want you to understand it. Thank you very much, and I will see you in the next part.